Hi everyone, thanks so much for joining me this morning for our webinar Cash Flow Made Easy. My name is Kristy Bailey. I'm a presenter and an advisor for Business Station as part of the Digital Solutions Program, which is a Commonwealth initiative. What we're going to go through today is based on my own experience as a small business owner and as someone that works in and around small business, obviously on a daily basis. I'm not an accountant or a bookkeeper, so do keep that in mind. But I don't think that you have to be to really maximize your cash flow and to have a deep financial understanding in a small business sense. Now, keep in mind that today's webinar is designed to be interactive, so please use the Q&A functionality, the chat functionality, or raise your hand at any time if you've got any questions, and I will certainly stop and answer them. We will also have a little bit of time at the end of the session for questions as well. All right, so let's get into it. First of all, what we're going to cover today, you're going to gain an insight into the cash flow process and how you can manage it, essentially. We'll talk about what cash flow actually is. We'll talk about the difference or even perhaps the relationship between profit and loss and cash flow. And you'll learn how to create your own cash flow forecast, as well as how to develop a really analytical approach to cash management. And we'll do that by teaching you or speaking about how you can effectively track your performance. And then finally, we're going to look at some strategies to enable you to stretch your cash flow further. So before we do get into that exciting side of things, what's cash flow? Well, cash flow is the term that's used to describe the amount of cash or the actual dollars that is generated or even consumed in a given period of time within your business. So it has a lot of uses both in operating the business and in performing financial analysis. I believe it's one of the most important metrics in all finance and accounting because it is the lifeblood of a company. It really allows you to evaluate the flow of funds in the business. And then once you do that, you're able to identify where or when there are potential problems. So it's all about timing. But understanding cash flow is a key part of your business success. If you can find out how to manage it, then you can work out how to stretch it further. Obviously, managing it, stretching it further alleviates a lot of stress and pressure, if nothing else, but there's many other benefits. Now, I always get asked the question of cash flow versus profitability. Now, profitability is the ultimate goal generally when it comes to the financial side of running a business, but you don't normally determine true profitability until the end of a period of time. So, for example, the end of a financial year. So that really is the key difference between cash flow and profit. Profit looks backwards or retrospectively, whereas cash flow looks forward. Profit is essentially the amount of money that's left over after all the expenses have been paid. So it's generally assessed at the end of a particular period, or the majority of people will assess that at the end of a financial year. So making a profit, in very basic terms, means that you've made enough sales of whatever your product or service is to cover all of your expenses or existing costs, and you've got a bit extra to spare. Now, cash flow, on the other hand, is the net flow of cash into and out of a business at any particular time. So that could be outlined in weeks, it could be months, you could look at it over a year period, depending on how you set up the reporting, but it is time bound. So whilst at the end of a financial year, it could have turned out that you were profitable, and on a particular month where your sales are low and there's a lot of expenses going out, you might not have had enough cash to actually cover those expenses. So thinking about it more from a timing perspective. Now, cash flow does matter, and it matters a lot. Having that good positive cash flow means that you obviously have enough money to pay all of your expected expenses, which is pretty important, of course, and to pay them on time or when they're due. But it also means that you'll know when you're able to reinvest in the business and potentially purchase capital or any other assets that are required to grow your business or even to run it more efficiently. You'll see when it's appropriate to return money to yourself or other shareholders as well. So some key areas to look at there. Now, another thing is that you will make sure that you've got some kind of buffer to cover you against future financial challenges. Sometimes there's unexpected things that pop up. And, you know, in that sense, it could be equipment replacement. It could be legal expenses. It could be anything unforeseen. So things do pop up and you have to know and be comfortable as a business owner that you can cover them. Now, having cash flow problems means that you don't have enough money in the bank to pay the necessary things, let alone anything unexpected. So that's really what we're aiming to look at here. You have to keep in mind that you can have profitability and suffer from cash flow problems as well. Now, clients paying late, having what I determine to be bad paying terms or early paying terms to your suppliers is the main reason that would normally happen. But figuring out your own cash cycle and your payment terms is one of the first things that you should do to keep cash flow positive. Now, in an existing business, it's really important to continually analyze it. But if you're looking at developing a cash flow forecast from a startup point of view, the very first goal should be maintaining a positive cash flow. So having a look at what your anticipated expenses are and ensuring that you have enough sales just to cover that. Now, once that's under control, I would then recommend that you pursue that ultimate goal of making it as profitable as possible by selling more, further reducing expenses, that kind of thing. But at a bare minimum, from a startup perspective, you have to know what it is that you need to sell in order to cover costs. All right, so that's where tracking it comes into it. So tracking cash flow really allows you to operate profitably and generate positive cash flow. Otherwise, you need to make necessary changes to improve your cash flow. For example, you might identify that you need to reduce certain expenses, or where you can't reduce expenses, you have to increase revenue in particular areas. It'll allow you to look at what's working and what's not as well. You'll be able to set budgets on what you know you need to achieve at certain times, and then track your actuals against your forecast to make sure that you're meeting those budgets. Now, it also does allow you to be sure that you have enough cash, or otherwise determine how you're going to get some input. So are you going to personally import? Are you going to seek input from investors, or are you going to need to sell particular assets? Now, it also allows you to make informed decisions on other areas of your business, like purchasing and at what times will you purchase, your staffing levels, your level of sales, leasing, whether you rent space, etc. So with all of that knowledge, you'll be able to reach your business goals. All right, now since cash flow matters, and it matters a lot, it's only natural that you should do everything in your power to increase it. So forecasting and knowing exactly when you'll have cash inflows and cash outflows is absolutely crucial. Now, to do that, you have to map it all out. So there are tons of different templates available online. I personally prefer those that are available on the Australian government website, so business.gov.au. But banks and a range of other websites will have cash flow forecasts readily available and downloadable, normally in an Excel format and normally free. So I'm going to show you an example of a cash flow forecast in just a minute. But once you've got your template, to get started, the very first thing you need to do is decide the period that the forecast will cover. Is it going to be monthly, and from what period? Is it going to be financial year, calendar year? Once you've determined that, you'll add in all the cash inflows and deduct the cash outflows for each period. And like I said, it's usually month by month within that template. Now, for existing businesses, if you've got historical data, a great way to start your cash flow forecasting is to get all of that data from previous years and input it into your cash flow forecast. Then you can decide what adjustments you want to make based on those past trends. So from what you know, are sales increasing? Are they decreasing or staying the same? Are there expenses that you had in the past that are no longer relevant, or are there new expenses that you need to add in? If you're a new business, when you're preparing your cash flow forecast, you'll have to estimate all of these things. You'll have to do your homework. You might have to get insurance quotes and other quotes and information to be able to plug this into your cash flow forecast. Sales figures do always change, so keep that in mind, and that's because they depend on a number of different factors. So it could be the types of customers you sell to, it could be how quickly they're going to pay you, what the economy is doing, so interest rate increases or unemployment rates can affect sales. as can border closures and COVID issues and that kind of thing. Also, what your competitors are doing can really greatly impact sales. So when you are inputting the incoming cash here, make sure you're as realistic as possible when you're forecasting. Again, if you're a new business, you're going to have to estimate what your inflows are. But because you will have got quotes and input all of your expenses, I would be working on the bare minimum to cover costs, and then have a look at, is that realistic to achieve those bare minimums just to cover costs? All right, so having a look at the template itself. So this is a template from the Australian government website. As I said, there are a range of different templates available, and majority of them are free. I've never paid for a cash flow forecast, or you could develop your own. I like using a template because it's got all of the sums and the calculations, all the formatting in place behind the scenes. But having a look at this, so we'll just have a quick talk through this. Now, cash flows are all about timing and that flow of cash. So you'll have to have an opening bank balance. Now, that will go up the top in this case. So this template that you see is a financial year. So it's going from July of one year to June of the following. You'll have an opening balance up the top, just under July. You can see that currently says $0, but you'll plug something in there. From there, you've got the incoming cash at the top in that first few rows of blue, with the grey being the total. And then the second block, which is bigger, is your expenses. And there's some suggested expenses there. So just to talk through those, sales or cash that's incoming, you've got sales, obviously, which is selling your product or service. You've got asset sales. So do you plan on moving any assets in particular? And if yes, what time will you sell them and how much will you sell them for? There could be debtor receipts, there could be loans that are being repaid, or there could be other incomes such as director contributions, investors, that kind of thing. So plug in all of the incoming cash in there. Then you've got the outgoing cash. Now, cash outgoing will really vary business to business. So use the examples here and obviously consider whether it's relevant to you. So purchases is the first thing, and that's purchases of your stock or materials. You've got accountant fees, perhaps any legal fees. Obviously, advertising and marketing is really important. Bank fees and charges are relevant. Now, you could have loan establishment fees if you've got cash incoming that's a loan in particular. You might then have an establishment fee or something like that that is an outgoing. Interest paid, you'll have credit card fees, utilities, so your power, water, gas, telephone, lease, or any other loan repayments that you have to make, rent and rates, motor vehicle expenses, repairs and maintenance of anything. Now, that could be your motor vehicles, or it could be repairs and maintenance of other things within your business, other equipment. Obviously, stationery, memberships, licensing, insurance, super, income tax, wages, etc. So you can add a lot more rows in there if you need to, but it will total it up. So you've basically got your opening balance, then you've got the total that's incoming, together less the outgoing will leave you with the monthly cash balance. And then in this particular template, that will carry over, and your closing balance at the very bottom there will be what you're actually accruing and left over with those periods together. So have a look at that and definitely plug in that information. Don't forget to account for GST. Of course, GST, if you're not including GST in your incoming cash at the top in your sales, then obviously you don't need to include it at the bottom. So just keep it GST exclusive. Otherwise, you might like to include it because your sales could come in monthly, but you're only paying GST quarterly, for example. So you might see that actually alleviates some of your cash flow issues if you do account for it at that time. Obviously, your employee expenses as well. So PAYG and super, your employee expenses from a wages perspective will be weekly or fortnightly, perhaps monthly, whereas your PAYG and super will just be paid at different intervals depending on how you're set up. So this is a really key template. It's fantastic, very simple to use. So as a very starting point, I would be plugging in some data into there and just seeing what it looks like. Now, you might be aware that you don't have cash flow issues, or perhaps you do, but seeing it in one simple document really identifies where you need to perhaps make changes. Now getting into the good side of things, how you can improve that cash flow. Once you've mapped it out and you're all set up to track it going forward, you need to then look at strategies to improve it. Now, it could be a profit or a loss showing on your cash flow statement, but you should still be looking at ways to improve it, because who doesn't want more profit? So strategies for improving cash flow generally fall into one of three categories. Now, that could be revenue growth, it could be your operating margins, or it could be capital efficiency. So we're going to take a look at some of the key areas within those three main pillars, but it's definitely worth looking at all areas of your cash flow, obviously looking at what's relevant to your specific business. So not all of this that you see on the screen will be relevant to you. Now, a lot of what we're going to be talking about here in terms of improving your cash flow is really about marketing. It's strategic marketing. But first, you have to understand your position to be able to improve your marketing, and then that will subsequently improve your sales and your cash flow. So just to expand on these three main pillars, you've got revenue growth, I mentioned, which is essentially the volume of goods and services that you're selling, or the price in which you're selling it for. Then you've got your operating margins, which is your cost of goods sold, and your selling, general and administrative expenses. Then you've got capital efficiency. So that's really a question of how efficiently you're using your cash to operate and obviously to grow. So looking at your property, plant and equipment and your inventory. So as I said, we're not going to go into absolutely every element that you see on the screen now today, but we will go into many of them. So to get that started, we're going to look at pricing. So a lot of businesses that I deal with, or when I first start working with a business, don't really know if their pricing's right, or if their prices cover costs. Also, a question that I have for businesses is what specific products or services are profitable, or which of your products or services are better than others. So thinking about that, do you actually know what are your most or your least profitable products and services? Thinking about that, how can you increase those products that are more profitable and decrease the less profitable products so that you're channeling your energy to the right areas? Thinking about how much time is invested in each of your products as well. And once you've set your prices, or when at the time that you set your prices, thinking about how you actually determined the price. So there's a few different pricing strategies. There is a cost plus strategy, and that's looking at what a product costs you and then marking it up a certain percentage. I saw an interesting thread on this on a business group that I'm in the other day, where they were looking at clothing, and someone was saying, what's the profit margin on clothing? And someone said it has to be 50%, or it has to be this and that. And there were so many variables, but I think you can't just look at what it costs you plus putting a percentage markup on. You have to also look at your competition, not exclusively look at your competition, but you have to consider that as well. What is your competition charging? And what are they selling similar products and services for? You've also got to look at what the customer is willing to pay. So you could have a product, you could mark it up so that you're doubling your money, or there's 100% markup, for example, but the customer might not be willing to pay that. So you then have to go back and have a look. All right, what are my competitors charging? How much is it costing me to operate, etc. A really interesting thing about pricing as well is that you can't just look at what a product costs you plus add a markup, because you need to know administrative expenses and all of the other expenses that we just discussed. So that cash flow forecast is an absolute key piece of the puzzle. In terms of setting your pricing, you do have to look at what it costs plus a percentage, or how much percentage you're making. You do have to look at your competition and what they're selling it for, and you have to know what the customer is willing to pay. So all three elements are really important to be effective. So keep that in mind, and have a look at your pricing. How did you actually come up with that pricing? That's really important. Now, this sort of goes back to your marketing strategy, having a look at what your product or service is, and what you're worth as well. So identifying your weaknesses, your strengths as well. Also looking at any gaps in what you're offering when you're doing research on your competitors, perhaps, and looking at what they're charging, making sure that you offer a fantastic product or service that is superior to your competitors. So very much your marketing strategy. What is it about your product or service that's unique or different and sets you aside from your competitors? And then looking at that, can you charge more because of that, regardless of what your competitors are doing? Or do you want to base your pricing on more volume, less profit? So when it comes to pricing and discounting generally means more work to make or maintain a margin, whereas increasing your price generally means less work and fewer customers to maintain a margin. So the issue with that is if you increase the price, you could potentially cut out a market, or on the flip side, if you decrease the price, you could attract the wrong market. So they are really important points to consider. Now, I have seen a case where discounting attracts the wrong market to the detriment of a business before. Some of your group buying sites do attract in interesting markets. So let's say the example of Groupon, Scoopon type group buying sites. They will ask you to provide an unbelievable offer. It could be 25 to 50% off. So you drop your price right down. You also pay them a commission. So the bottom line that you're getting is actually very low. It does definitely attract more customers, and you'll sell tons of vouchers or of the particular product, depending on how long it's available for sale for. But when that customer walks through your door, are they the right type of customer? Are they as easy to satisfy as your regular customers, or are they harder to satisfy? Do they spend as much on purchasing additional products? Do they stay loyal to your business? All of these factors are really important. So dropping your price to get more customers is not always a good strategy. Sometimes it can improve cash flow there and then. And I saw this a lot when we first started going into lockdowns as a result of COVID, particularly in the beauty industry. So there are a lot of day spas, beauticians, that kind of thing, that would offer vouchers. And really, you know, I think I purchased one for about $200. It included tons of different stuff, but I had to book it and pay for it there and then when we were in lockdown, knowing that I absolutely couldn't use it, but then I had 12 months to use it. So for them, they're going through a period where they've got no cash coming in, come up with a really interesting strategy to get that cash and keep that cash coming. And then obviously, because they've still had outgoings whilst they're in lockdown. And then obviously we've got the voucher as a consumer to use at a later date. So those kind of ideas can really help with cash flow at certain times. Then looking at volume. So with your volume, can you increase your volume overall, and specifically the volume of more profitable products and services? Or perhaps there's new markets to sell to. Maybe you can create new products or improve your sales processes to allow you to produce more or to be able to sell more. Now, generally, as a bit of a benchmark, to determine profit enhancement, you look at a few different options. Now, this is outlined in the table that you see on your screen. So first of all, there's market penetration. Now, market penetration is what you see in blue there. That's where you've got an existing product and an existing market. So it really occurs when a company penetrates a market in which a current or similar products already exist. So essentially, you're just gaining your competitors' customers. The next area of profit enhancement is product development. That's what you see there in green. So that's where you're developing new products for existing markets. So thinking about launching a new product or service, maybe through what you've identified in researching your competitors, or even through trend tracking, you've found that there is a new product that would suit for your current market. This could really increase repeat purchases and customer loyalty because you're getting them back for a different reason. The next element is market development that you see there in orange. Now that's existing products being offered to new markets. So you're developing new markets, perhaps broadening your scope to the international market when you currently have a bricks and mortar store that serves mostly local people, going online versus offline, or perhaps you're an online business and you're going to start some pop-up stores or open some pop-up stores around the place. So looking at new markets there. Then in the red, you've got diversification. Now, diversification is a new market, new product. So thinking about who you are as a business, can you spread into new areas and sell something completely different to your existing core product to a different market? So some really interesting profit enhancement strategies there, and it is important to look at what you're doing and identify, okay, if I do this, this is actually really product development, or it could be market development. So identifying which of those categories your ideas to improve volume actually fall into. Now, in terms of volume, you also have to consider, as I mentioned, your sales processes. If you can better your processes to allow you to sell more, that is fantastic. Identify if there's any bottlenecks in the process, and that will allow you to hopefully look at some mitigation around that. Can you increase your advertising? Obviously, that then has a spend attached to it. But in terms of selling more of your existing products to existing markets, advertising is a key way to do that, providing you've actually forecast the advertising spend. Also, in terms of increasing volume, salespeople are really important. Who is it that's selling your product or service? Are they good? If yes, make sure that you've got a really good plan in place to retain them. If no, what plan do you have in place to attract new staff that are going to be able to sell your product at a high level? Customer rewards programs are great to get people back. So also looking at your sales statistics, what is your repeat? What are your repeat purchases like? Or your repeat visitation, or your repeat customers. So tracking that is really important. It costs something like 8 times more to attract a new customer than it does to keep an existing customer and keep them coming back. So that's a really interesting avenue for volume, and a low-cost avenue as well. All right, so that's volume. Now looking at debtors, this is a great area to improve your cash flow. A very interesting ATO statistic for debtors is that small businesses in Australia are owed $26 billion at any one time due to debtors. So that's a lot of money that's out there that small businesses don't have that they probably need. So absolutely address any issues with debtors. And I believe the best ways to do that are, first of all, to look at collecting payments as quickly as possible. That prompt collection of payment is going to mean that of that $26 million that's out there being owed to small businesses, you're not a part of that. So trying to reduce that. You could even look at offering a discount for prompt payment, or depending on the nature of your business, some businesses have a late payment fee, which is very common, whether it's your water bill, your power bill, your speeding fine. There is generally a late payment fee. So thinking about your business, is that appropriate for you? Or is that something that would then impact your customer service? So you've got to balance that out. Invoicing earlier is another really good strategy to reduce that debt that's owed to you. So maybe don't wait to the end of month to invoice people. Maybe send invoices straight away. If you've got customers that, and this is a B2B sense generally, but if you've got customers that purchase a lot from you throughout the month, maybe invoice twice a month. So maybe invoice mid-month and then end of month. So that you aren't waiting. If someone purchases something on the 1st of the month and you're not invoicing them to the 30th, and then you're giving them a week, 14 days, 30 days to pay, it could be up to 2 months that you're out of pocket for something that chances are you've already paid a supplier for. So invoicing earlier is a really good idea there. Switching from paper to electronic invoicing is really important. Electronic invoices are a lot more professional than paper. They're easier to send, they're easier to store, and it really greatly reduces turnaround times. I actually received a paper invoice just the other day, and it was quite inconvenient to get a paper invoice. I had to scan it into a system, etc. There was a process, plus the postage time, chances of it getting lost in the post, that kind of thing. So absolutely go to electronic invoicing. Make sure that payments are followed up promptly if they're not paid on time, and an automated payment follow-up process means that you'll get paid even quicker. So keep that in mind. And it's the less not only will you get paid quicker, but you'll have to input less workload to get the payments in as well if you've got some automation there. Now, e-invoicing is another thing that you consider. So e-invoicing is an automated digital exchange of information directly between a buyer and a supplier's accounting systems. So this is now slowly sort of being introduced in Australia. You won't have to generate a PDF or a paper invoice of any sort. You basically connect two systems on the same e-invoicing network. So the one in Australia is People. You can start using accounting software like Xero to send and receive these e-invoices. And again, the ATO have really got on board and are starting to promote this. Obviously, the Australian government use this system, but they've stated that it can cost over $30 to produce a paper or even a PDF invoice compared to less than $10 for e-invoicing. So it really reduces some costs as well. Now, reduce your terms as well, which I think I did mention, but make it shorter than 30 days. So not only, I did mention invoicing earlier, but reduce your terms so that you're getting the money in sooner as well. And the last point that in terms of debtors is make paying easy. So if you're offering multiple payment methods to your customers, you're giving them the choice to pay in the way that suits them, and making it easier is going to mean there's less barriers to them just paying the bill. So think about that as well. Obviously, if you're introducing things like credit card payments or and that kind of thing that can have fees associated with it, you might look at, if you've got a subscription-based business, just direct deposit, direct debits set up from people's account. There might be small fees for that, but think of the time that will be reduced by invoicing and chasing payments and all of that kind of thing. So there's a lot of merit in that one. All right, assets. Now, assets is very straightforward. I would simply look at if you can free up cash by selling underused or even unused assets. Now, businesses accumulate assets over time, and sometimes it gets to a point where they just don't need them anymore. So making sure that you're selling any unnecessary assets to increase the cash in your business is a great idea. It also will save on costs like insurance or perhaps storage. So keep that in mind. Now, another area in terms of assets is looking at leasing to free up cash. So thinking about what assets you have, does it work out better for you to actually lease an asset? It could then perhaps remove the cost of maintenance. It could reduce the risk of complete failure requiring replacement. Leasing smooths out your cash flow as well. So if it's appropriate for your business, it can be a really good way to free up cash. I would also look at perhaps refinancing or even negotiating better terms with any existing loans or bank agreements that you might have around assets as well. So that one's very straightforward. All right, expenses is the next area. So put very simply, expenses decrease the amount of cash that's available to your business. So absolutely think about what you can do to reduce expenses. First of all, can you defer any expenses or look at better payment terms on them? Can you rent a cheaper location or negotiate a better deal with your current lease? Or are there any other cheaper alternatives to expenses that have been listed on your cash flow forecast? So there could be new plans for your mobile phone or new technology packages. There could be expenses that are ongoing that you don't actually require. There's things there that you don't need anymore. Can you remove them entirely? Look at things like your insurances. When was the last time you reviewed insurances or got competitive quotes for various expenses? Thinking about that side of things. Now, the other thing about expenses is sometimes you can set up payment plans to, again, smooth out your cash flow. So insurance is a good one. A lot of time, commercial insurance, you can have a payment option. You might pay a little bit more at the end of a 12-month period, but it very much smooths out your cash flow. In terms of staffing, look at the comparison in outsourcing versus in-house staffing. Now, it can be really effective for specialist roles or particular tasks within your business. So bookkeeping, particularly with more automation, marketing or other administrative roles. there could be the potential to outsource rather than having an employee there, and it's more of a pay on demand type thing as opposed to having the liability of an employee 12 months of the year. I'm not saying get rid of your staff just yet, but just as an idea. The next element to consider is inventory. Now, inventory represents cash. So if you hold it for more than 90 days, it can really cost you significantly. Now, in terms of your inventory, thinking about it, can you source cheaper stock or materials? I would recommend that you always review your pricing from suppliers and do it regularly. So even if you've had a great long-term relationship with suppliers, it might be that you get some comparative quotes. You might then go back to your original supplier and say, look, we do want to stay with you. However, I have a quote that's come in a bit cheaper. Can you match it? So that kind of thing is fairly typical. And you can remain loyal to suppliers, but you should absolutely be making sure you're always getting the best deal. Purchasing power comes when you understand your own cycle. So when you map out how much cash you have at certain times versus how much stock you use, you can see if there's any efficiencies there. So perhaps, in November, you've got an influx of cash because of people pre-ordering or doing something that results in purchasing and therefore cash. Can you then look at purchasing stock, bulk stock, at that time or whatever that might be, so that you can then get a better rate, so that purchase power can really help. Now, just on your stock, maintaining the right levels is really important. You have to make sure that your stock levels aren't too high, but also you can't really ever afford to run out because that could impact your customer service and the customer experience, which could then result in either bad PR or a lack of repeat purchasing, that kind of thing. In terms of stock as well, track the movement of it, have processes in place to identify when new stock should be ordered. Perhaps try to return anything unsold if you can. I know a lot of suppliers have really tightened up on this since COVID, and obviously everyone shut down at a particular time all at the same time. So people tried to return stock and get refunds and that kind of thing. But understand your suppliers' return policies. If you can't return unsold stock, think about how you can move it faster. Maybe going online as well as having a bricks and mortar store or vice versa could be helpful. I would also say using software with stock is really important. If you have some kind of platform to manage your stock, otherwise are you doing it manually? As long as it is being managed is really important. Replacing any slow moving or obsolete stock with stock that has a faster turnover is crucial as well. So knowing what sells and what doesn't is very, very important. A lot of good point of sale systems will tell you this information. But it's important that you're actually pulling those reports and actively tracking it yourself. If you don't have point of sale software, make sure that you have some kind of mechanism in place to track this kind of data because it's really useful to you. Drop shipping or just-in-time stock orders are also great. Now, you might be able to find suppliers that provide you with stock only when you need it, and that way you're not wasting money paying for stock that is then sitting in a warehouse or a storeroom. Drop shipping could be great. That way you only order it once you've had an order from your customers, but absolutely make sure there's no delay on delivery and no issues there. I heard an absolutely horrifying story about drop shipping just the other day where a company was drop shipping, a customer ordered something and the product that got delivered to them was absolutely not the same product, and it was quite an offensive product that they got. So make sure that you have a very reputable company that is doing that, and you've got any mechanisms in place to make sure that kind of thing just doesn't happen. Now, also making use of your supplier payment terms, make full use of them. And what I mean by that is don't pay any invoices early. Try to get longer payment terms if you can, because that really equates to an interest-free loan to you. Now, keep in mind, you might be purchasing stock today. Let's say you have to pay for it at time of purchase, therefore the money's gone out of your pocket. You might not then get it for another few weeks. It might take you another few months to sell it. So potentially you're out of pocket for a number of months before you get that money back and get your cut. So making full use of terms and getting as longer terms of trade as possible is going to be really helpful in that regard and really alleviate some of your cash flow issues. Right, staffing. So I did touch on this in terms of outsourcing, but when it comes to staffing, that is an absolutely key area that can become a major expense and often the biggest expense for businesses. Now, in terms of staff management, firstly, rostering is really important to cover demand, to produce revenue, obviously, but don't overstaff. Making sure that you're matching the roster to peak periods, or have flexible staffing arrangements in place so that staff can come and go throughout a day if you've got split shifts and that kind of thing. We did touch on outsourcing. Definitely consider outsourcing. There could be those specialist roles that you could outsource so that you're only paying on demand, as I said earlier, rather than having a full-time employee in these roles. Sometimes you will pay a little bit more for an outsourced role, but it is then an expense as opposed to a liability. You will also then perhaps get a more highly trained or a more specialist person in those roles. So it can definitely work. Increasing the flexibility of your employees is really important as well. Can they have multiple roles or be able to multitask? I think that's a really key thing. Making sure that they're trained across multiple areas within your business as well. Now, aside from multitasking or having flexible workers, maximum utilization of your staff is crucial. So thinking about setting targets to maximize the productivity of your staff could be another strategy as well. Incentivizing sales with commissions or rewarding staff behavior that improves cash flow, so reduces expenses. So setting some targets around either sales or expenditure. It is a great way to incentivize your staff, but if you're doing things like commissions, make sure that those commissions are only paid when you've got the payment. So if they're getting paid a commission based on sales, but the customer hasn't paid yet, they shouldn't be getting the commission, because again, you're going to be the middleman. You're going to be the one that's out of pocket. The employee will have their money, the supplier will have their money, the client hasn't yet paid you, so you're then out of pocket, as I said. So keep that in mind. The other recommendation in terms of staff is the qualifications of them and making sure that you are employing staff that are more qualified. So paying a staff member that is more qualified will result in obviously paying them a little bit more, but it can really greatly increase your sales and your customer satisfaction, which then in turn creates positive word of mouth, repeat customers, etc. So on a balance sheet or on your cash flow forecast, unqualified staff might look like a quick win, but in fact, it can be really damaging in the long run. So when you think of things like on-selling, upselling, suggestive selling, cross-selling, really more qualified, more confident staff is absolutely crucial there. If you've got someone that's unqualified or not the right staff member, it can really impact that customer experience. Even if they can still make the sale, the transaction works okay, they can physically do it, that level of satisfaction from the customer might not be the same as someone that's more qualified. Now, the other thing with staff is that if you do get these great, highly qualified, fantastic staff members, retention is key. Reducing staff turnover is a key goal from a cash flow perspective because it has such a massive impact on the bottom line. Staff are expensive to not only hire, so that whole recruitment process is time consuming and expensive. Then you've got the training as well, as uniforms and HR and all kinds of things that go along with new staff members. So avoid those unnecessary costs by being the employer of choice. Once you've got staff that are the perfect fit for your business, keep them. Do whatever you can to keep them. That's really the staffing side of things. All right, so that covers different strategies to improve your cash flow. As you go through and complete your cash flow forecast, keep those strategies in mind. And then when you get to the point that you've determined if you've got a profit or a loss, you'll have to make some considerations. So when it comes to profit, don't be too quick to take out the cash. Invest it back in to manage cash flow for future months or years, or even use it to pay down debt. So be smart with that money. If your forecast shows a loss, then you'll have to possibly input your own money. So there might need to be some owner or director contributions. You might need to seek equity from investors, or you might have to borrow to fill gaps. So you might have to speak to your bank about a loan or even an overdraft. An overdraft is a really common solution to seasonal cash flow issues or even debtor cash flow issues. So an overdraft is very common, and you'll quickly identify from a cash flow forecast if that is going to be needed. Now, in terms of inputting your own money, that takes planning and time to make sure that you can personally afford that, or if there's other directors involved. The other thing is getting new equity from investors. You'd have to seek an investor, present to them, get them on board. There's a massive legal process that goes with that. And so that obviously takes time. So any of these things, from a loss perspective, you have to spend the time to map them out. And that's a key reason to make sure that you are tracking your cash flow, because if you know now that in June next year, you're going to have serious cash flow issues, you might have to start working on resolving them from right this moment. And it might take you that period of time to get to the point of actually resolving them. So keep that in mind as well. Now, the very final step, and probably the most important step of all, is to review what you estimated on that cash flow forecast, that template that we spoke about, against actuals. So make sure that you do go back and check what you estimated against the actual cash flows for each specific period, which could be week, it could be month, or it could be quarter. When you're doing it, highlight any differences between what you estimated and what the actual cash flows are, because it'll help you see why your cash flow didn't meet expectations. It could have been lower sales than you forecast, and there could be a number of reasons around that, or it could have been higher expenses. So you're going to have to take different actions for different situations as well. If the cash flow is all about timing and the flow of cash, so when you're preparing that cash flow forecast, make sure that you're as accurate as possible, obviously as realistic as possible with your sales and your expenses and that kind of thing, but as accurate as possible on the timing. So when you're comparing your forecast to the actuals, it will actually be a proper comparison. So that's a really key thing as well. Now, in terms of cash flow mistakes, the biggest and most common mistakes that I see are, first of all, running a business from your bank balance. It doesn't account for any planned or unplanned expenses, or perhaps even the seasonal nature of your business. You might have a high season and a low season, but you do see business owners that go, there's tons of cash in the bank. Yep, let's buy this, buy that, etc. And then a few months down the track, they realize that they actually probably shouldn't have done it, that they needed to reserve that cash for tougher times. Improper management of taxes and government expenses is also another big area. These government expenses and taxes are clear and they're known, so plan for them. Whether it's GST, super, PAYG, keep in mind that you've got it mapped out on your cash flow forecast. Now, there are penalties for late payments. It's very simple to account for taxes, so do that in your planning stages. Now, spending too much money on sales is also a big problem. As a small business, you obviously need new customers, but you've got to work out what the cost of those customers actually is. Are you tracking the acquisition cost of a customer? And are you tracking the total revenue that each customer actually generates you? Because it has to be higher than that acquisition cost. Now, overspending on the acquisition cost might lead to gaining a small value customer that doesn't have a very good return. So making sure that you're tracking that is really important, because a lot of businesses do have issues with that, because they perceive that the more customers they have, the higher their profit will be. Now, discounting comes into account here. If you know your customer value, you know your acquisition costs and what they are, plus the cost of sales, then you know how much you would need to charge the customer, or how much you can discount if you've got promotional periods. So keep that in mind. Another big mistake is just not forecasting, for obvious reasons. Hopefully we've gone over those reasons enough today so that you are actually confident that you need to forecast, but not forecasting is a massive, massive mistake. Not collecting cash fast enough. If your customers are delaying those payments, but your supply chains are short, then you're the one that's caught in the middle. Unpaid invoices are also a cash flow killer. And what's worse than late payments or unpaid invoices is when you as a business are the one that's responsible for not even raising an invoice. So you'd be surprised how many companies that I've personally dealt with that will forget an invoice here and there. I'm always honest and I'll let them know because I understand how much it can impact small businesses, but I'm sure that not everyone is. So it is a big problem, particularly in a small business. Make sure your systems and processes are tight enough that this just doesn't happen to you. Now, holding inventory for too long costs you money, which we did discuss earlier. Inventory represents cash. That's an absolute cash flow mistake. Don't have it sitting there doing nothing for your business. Taking too much cash out is a big mistake. I mentioned working from your bank balance, but some businesses or business owners will just take cash out of their business pretty sporadically. If you can afford to do it, then that's great, but make sure that you've tracked it. Obviously, as a small business owner, you should be getting some money for what you're doing, whether that's taken as a wage, whether it's taken periodically. I absolutely agree that you have to be earning money for the work that you're putting in, but it has to be accounted for and planned for. So keep that in mind. Now, if you do suffer from negative cash flow, you absolutely can recover from it. So don't do your cash flow forecast and then go, that's it, it's all over. It's cash flow negative. First of all, you have to look at what caused the issue in the first place. Did your expenses blow out? Did your sales come in under? And then analyze that and what the cause was. The second thing, most important thing, change your payment terms, then reduce your operating costs, then run promotions to get new sales or approach new clients. And finally, if none of that works or is appropriate to you, meet with a lender or an investor. So absolutely don't give up. Cash flow, understanding your cash flow is absolutely crucial. I'm sure that you've got a good understanding of that today. Now, that is it from me. It wraps up the session on cash flow. I hope it makes sense to you all, and I hope there's some good things that you can take out of that to improve or at the very least better understand the cash flow position in your business at any given time of the year. It's all about timing. I'm going to stay on now and answer any questions that you might have. Just keep in mind we have only scratched the surface. If you want to know more or if you want to talk about any aspect of your business, you can always book a one-on-one appointment either with me or our range of specialist advisors. Now, this advisory service is available if you're not already signed up to it as part of the Commonwealth Government initiative, the Digital Solutions Program. You get up to 7 hours of personalised business mentorship for just $44. 3 of those hours are one-on-one with an advisor of your choice. So they could be an advisor that is very qualified in a specific area, and that can be anything from digital marketing to advertising to cash flow, HR. There are a huge number of advisors that we have that are all highly qualified in their areas. So keep that in mind. Now, there are some key eligibility criteria. You have to have an ABN that's registered in WA, Queensland or NT, because they are the areas that Business Station cover. You have to be a business that is operating for profit. That doesn't mean you have to be profitable, but you can't be a not-for-profit business, and you have to employ fewer than 20 full-time equivalent staff. So thank you again for your time today. If you have any questions, please stay on the line and drop them in either the chat or the Q&A functionality. I really appreciate you spending the time with me today. Good luck with your cash flow and in your small business, and we'll talk again soon.